Claire, it's a couple of weeks since the LA fires have died down. I know there's still some small fires going on, but what are you hearing about in terms of the extent of the damage now?
The latest estimates of the number of structures that were destroyed by the two really big fires, with the Palisades and the Eaton fires, is around about 16,000, 16,400, I think, are the latest numbers. Now, a couple of weeks since the fires, so they've been doing a lot of aerial surveys to come up with these numbers. Not all of those are houses, but the majority of them are.
And we've got Todd Russell, who's going to join us in a moment from E2 Value, talking about a question of around what do insurers pay out and how to understand the rebuild costs, which of course is separate from the value. But with regards to what you've been hearing about the losses coming through now, it's still quite early days. Is there anything you've been seeing you kind of got confidence around?
There's a range of insured loss estimates that have been put out, quite a large range actually, but averaging out at around about now at about $30 billion. So the estimates have shifted upwards over the last 2 to 3 weeks. As you and I were discussing 2 weeks ago, Matthew, it was still very early days at that point. So there's been a coalescence in the 25 to 35 billion range, although there are a couple of estimates out there higher, as high as $45 billion insured losses. Some of the uncertainties around where that loss will end up remain in terms of the amount of that loss that will be covered by the insurers, how much will flow into the FAIR plan, which we know has got quite high exposure in those two areas, potentially covering around about 10 to 20% of the structures burnt could be in the FAIR plan. Now, they cap coverage limits at $3 million per structure. So how much of that 30 billion goes to FAIR plan? How much of that then exceeds their deductible levels and goes into their reinsurance plan? So the FAIR plan has reinsurance and it's a co-insurance. So above $900 million, there's co-insurance in the reinsurance tower between the reinsurers and the participants in the FAIR plan. All of the insurers in California are participants in the FAIR plan. So if the FAIR plan doesn't have sufficient funds in its reserves or through its reinsurance, it can make assessments to all of those insurance companies. So there's a co-insurance reinsurance plan, which goes up to $4.5 billion for the FAIR plan. And I think the other thing I was reading about this last week as well was a little bit of discussion about whether it's one event or two events, which then could influence how much flows through into reinsurance. Generally, a wildfire is counted as one event if they happen within a certain distance and time of each other, typically which would be within 168 to 240 hours and ranges of 150 miles. The Palisades and Eaton fires were close enough to count as one event, but one of the insurers last week, I think it was Mercury General Insurance, said they may be able to treat it as two events and that PCS, Property Claims Service, have designated them as separate events. So, of course, if they were two events or one event, will again influence how much of the loss, whether it's through the private insurance market or the FAIR plan, how much of that might go through into the reinsurance industry.
And Claire, just jumping in there, the FAIR plan you've been talking about, of course, that is a state-mandated pool. As you mentioned there, anybody writing insurance in California needs to be part of that. And it tends to be the insurance or insurance plan of last resort for people that can't get insurance through or choose not to get insurance through the more traditional insurers. So that's some reference about why the losses are falling into that.
Yes, that's right. The FAIR plan is essentially a fire insurance pool comprised of all the insurers who are conducting business in California. So every member company participates in the profits and the losses of the plan. So if there isn't sufficient funds within the plan right now, some funds plus the access to reinsurance, but if there isn't sufficient funds from those, then they will also make what are known as assessments on the insurers that have to essentially cover the losses that the plan is liable to. So insurers in operating in the state can be liable to losses, insured losses coming to them both from the policies they write themselves and through the FAIR plan, and will be liable for some of the FAIR plan losses potentially.
One that I think a lot of people have been interested in is what's happening with utilities. I mean, we've had quite a lot of liability falling on the back of one of the utilities a few years ago, multiple billions of dollars for causing the fire. How does that play into this in terms of insurance costs or the utilities picking up some of the costs that might have otherwise gone into insurers?
Yes, so if any of the utility companies are found to be liable, if any of their equipment was found to have played a role in the ignition of any of the fires, then they will be found liable for funding the cost of repairs and the damage. I mean, right now, they've been looking particularly for the Eaton fire at potentially the role of utility company equipment, less focus on other sources for the Palisades fire. It will take quite a long time. But if that is the case, then through a process of subrogation, then the utility company may be found liable for a substantial number of claims, and that could then actually reimburse, to some extent, the costs of the insurance companies. Actually, it's just happened, for example, the Hawaii fires a couple of years ago. The utility company there has just settled a $2 billion claim for their liability, which is now feeding its way back through into the system to subrogate back to the insurers and potentially to the reinsurers as well.
And then, Todd, turning to you, you've got E2 Value alone over 20 years of experience of assessing the rebuild cost for properties. It'd be helpful just to understand what are the key aspects that insurers are looking at when it comes to making out the payment.
Sure, Matthew. Well, most of how the payments will be paid out was based on the policy itself. So for most homeowner policies or residential policy, they're going to have a definition of replacement cost. It's typically going to be for like, kind, and quality. So meaning the age of the home is affected, how they rebuild it, the level of quality. Claire had mentioned the FAIR plan is a $3 million limit. That's what they're going to write as a home up to $3 million or so. So if the home's worth, and some of those homes in the Palisades area could have $5-8 million replacement costs, and they have a FAIR plan number, they're going to be capped out at 3. For most of the homeowners, that definition is they're going to build from the footings up, take a percentage. So you have a qualifier in the policy. If you hit 80% of that number that they think it is for replacement cost, the policy will kick in. If it's below that number, they'll do co-insurance. So you get a proportional payment for the deductibles applied. So a lot of the effort after this process goes through is someone defining what they think the replacement cost was as the day of the loss. And that's really what it's about. It's not what the replacement cost is going to be because there's been a catastrophe or catastrophe load and those things. The day of the loss is the impact of what it's going to take to replace that structure. Commercially, there's a little more leeway in what they define as replacement cost. Get back roughly what you had to be put back, indemnify where you were before.
And that's different than a lot of people think about value. What tools or what are insurers looking at in terms of the actual way to assess that cost? And I guess that's particular. You're talking about how that varies when you've got a lot of losses happening in a very concentrated area just now.
Well, and again, with a great deal of empathy for the folks going through this, but, the U.S. builds 2 billion plus structures every year. And so there's a lot of lumber, there's a lot of materials, there's a lot of things in the place. So the amount of materials that are going to be used to rebuild 15,000, 16,000 structures is not really something that's going to shift the system. The shift comes in that you need someone to pour the foundations, put together the wood, the electrical part, the plumbing part, and those things are really what's going to drive the number and how long it's going to take, because this probably could be 6 or 7 years, regardless of all the political things or all the other things that are happening. And, Altadena is going to be reshaped. Pacific Palisades is going to be reshaped by this. But just on a normal basis, that's a multi-year process. In Paradise, the Camp Fire, we're 8 years later and only 25% of the structures have been rebuilt. And so that tends to be the way things are going to lay out when there's this many structures involved.
What about additional living expenses, ALE?
That's the biggest thing. I think that's the part that really is going to impact people the most because their lives have been upset. If you're living in Altadena, you have kids in school, lived a certain distance from where you work, you've got 3 or 4 years of planning before you could ever get back to the house. So a lot of people are going to figure they're going to move somewhere. They're going to take the settlement they can have, pay off their mortgages if they can, sell the land if they can. But they have got 3 or 4 years of adjustment living somewhere else. And a lot of the additional living expenses are going to be to reset your life in a different location. And that's a big deal. I think in this process, especially because of how it's concentrated, it's a pretty tight housing market in the U.S. as it is. Rental homes for that many people is going to be a big deal. That's going to really change the additional living expenses calculation.
And I know you look very carefully at how people are coming up with these loss estimates. Claire mentioned 30 billion. There are people talking about 40 billion insured loss. So how does that fit with your own expectations of what you've seen?
I mean, I think when you do a quick math of 16,000 times an average value in the area, you're in that range. It's pretty wide range of home. I mean, Pacific Palisades, Malibu have very high-end homes. And so, there's multi-million-dollar structures in each one of those locations. There's a lot of commercial real estate in there too. So the commercial side is going to have an impact on it. But so, yeah, sure, 35 to 45 billion, could be. And the other part of it is actually insured losses versus economic losses. I think a lot of the neighborhoods are going to be impacted. They're going to redo infrastructure. And that, again, is going to delay the rebuild part of it and ramp up the additional living expenses. And so it's just because it's so concentrated in a very expensive, populated area, this is going to have a lot of different sides to each claim settlement.